A fundamental part of any time value of money calculation involves the discount rate. To get the right answer in your calculations, you need to know that there are a number of different discount rates, and you also need to know when to use those rates. This is the 7th lesson in the Finance Fundamentals TVM crash course. See the description below for details on how to find the other videos in the series. Most financial calculators use the letter I to label the key that you need to use to input the TVM discount rate. But interest applies only in limited situations, and it is not the only discount rate in finance. There are numerous others. We are going to take a look at some examples of these other discount rates, and I will provide you with some guidance on how to make the right selections. But before we do that, I think it's useful for us to be aware of the underlying principles behind the identification in general of what discount rate needs to be used in what situation. That principle can be summarized as follows. The TVM discount rate that you use in finance must align with the risk, timing, and other relevant characteristics of the cash flows that are being analyzed. For example, if you are working with dividends, which are the cash flows from an equity source, you would use a rate of return on equity as your discount rate. If instead you were looking at the coupons paid on corporate bonds as the relevant cash flows for a TVM situation, you would use the rate of return on debt as your discount rate. So applying the principle that the discount rate must be coherent with the characteristics of the cash flows in question might seem to be trivially easy. This table implies, for example, that if the cash flow source is equity related, then your discount rate would be a return on equity, and the abbreviation, unsurprisingly, would be R subscript E. But there are some details that you need to watch out for. For example, dividends are not the only cash flows related to equity instruments. You could also have share buybacks. You could also have on your timeline the terminal value of an ordinary share at the end of your investment horizon, or you could have free cash flow to equity. Corporate debt can take on a number of different forms. It could be money market instruments or bank borrowings or bonds issued by the company. In all cases, the cash flows related to those financial instruments, which would be things like interest, bond coupons, the repayment of principal on bank borrowings, or the redemption of the face value of a bond at its maturity, are all discounted at the rate of return on debt, which we abbreviate with R subscript D. For preference shares, much more straightforward. There are usually just preference dividends, and if the preference share is redeemable at a particular maturity date, that redemption amount would also be a cash flow that would be discounted, this time at the rate of return on, unsurprisingly, preference shares. If the cash flow source is government debt, you might think that it would make sense for the discount rate, following the principles we've been applying so far, that the discount rate would be the rate of return on government debt. Well, yes, it is, but there is a special name in finance for that rate of return on government debt, and it is the risk-free rate, which is absolutely fundamental and foundational throughout finance. Next, we have free cash flows to the firm, or FCFF. These cash flows must be discounted at WACC, which is the weighted average cost of capital. In this particular context, FCFF discounted at WACC result in an estimate of the enterprise value of the company as a whole. And finally, we have operating cash flows, which are also discounted at the weighted average cost of capital. In this particular situation, we are talking about the evaluation using capital budgeting of a potential project. So this final situation is more of a corporate finance scenario. And finally, for this video, a quick note on terminology. In the Finance Fundamentals video series, in the publications and the question banks, I almost universally use the letter R to represent the discount rate and distinguish it, as I've demonstrated in this video, using various subscripts. As you read other sources or watch other videos, you may also encounter the letter K, which is another way of representing the same discount rates that I was talking about in this video. The choice between whether you use R or K really doesn't matter. It is largely a matter of personal preference. Don't let any author or presenter tell you otherwise. It really is just a matter of historical accident that, generally speaking, sometimes, but not always, in a corporate finance context where you are considering the discount rate as a cost of capital, that the letter K is sometimes used. And that is it. If you've derived some benefit from this video, I would very much appreciate it if you would consider subscribing to the channel. It's for free. It doesn't cost you a cent. And maybe perhaps even think about clicking that like button. That does help the channel with the infamous YouTube algorithm. And again, thank you for watching, and I'll see you in the next one.